I do think it's important to view gold and silver as money because they're the only assets that meet the criteria, especially gold, over long periods of time.
So, Jeff, how should our listeners, maybe change their thinking if they're on their fence about buying gold or silver? Is thinking about metals as investments versus thinking about them as money an important difference in your view?
Yeah, I mean, it'll end up being an investment if you sell it for a profit. But I do think it's important to view gold and silver as money because they're the only assets that meet the criteria, especially gold, over long periods of time. In other words, retaining value, retaining purchasing power. The dollar bills in our wallet meet all the criteria for money, except for that. They leak value, they erode value, right? Only gold and silver can retain value. So once you really internalize that, I think it makes a difference in how you view them. Again, I do think it's fair to state that is more true with gold than it is with silver. So, I think someone who's going to invest needs to understand that difference. And of course, this is what Mike Maloney spends a lot of time on. This is his core thesis, or one of his core theses, is that gold and silver are money. They're the only thing that retain purchasing power over long periods of time. That alone is a good reason to own them. And there are historical studies that show they retain purchasing power better than dollars. Just look at the loss in purchasing power since 2000, since Y2K, if you remember that, if you're not too young. Remember what happened in Y2K? Everybody's panicking, getting ready. We'll go from that date to now, and you can see that gold and silver have risen in value in purchasing power, and the US dollar has lost a lot of its purchasing power. That's the key difference.
So when you hear a comment like gold and silver are dead, what does your research show? And what would have to fundamentally change for that statement to be correct, that gold and silver are dead?
Well, gold and silver clearly are not dead. They're tradable assets, meaning they're on an exchange and they can trade, every second of a trading day, 23 and a half hours, whatever it is, around the clock, around the world. So they clearly have value. Investors obviously see that. Gold is still 1750 or whatever, 1780 as you and I talk. Silver is up from its 2000 low, so or the past 20 years. So I don't buy this argument that they're dead. If they were dead, then gold would be at $250 an ounce and silver would be $2.50 an ounce, something like that. I think this is why Harry Dent, and not to call somebody out, but just to use him as an example, why Harry Dent is wrong. I actually bet him because he kept saying gold's going to as low as $250 an ounce. I wrote him an open letter. He accepted my bet and he lost. And I think this is one of the core reasons. And he paid me, by the way. He's actually he was very gentlemanly about it. So
that was going to be my next question.
Yeah, I got an ounce of gold from him. It was great. He sent me a check to buy an ounce of gold with the premium. He was a true gentleman about it, But that's the key difference. He doesn't see gold and silver as money, and I do. And Mike Maloney does, and many of us do, right? And that's the reason. Because it's money, it's going to always have value. And this has been shown to occur over 3,000 years plus. So who should I believe? 3,000 years of history, or some analyst who comes along and wants to get his name in lights and headlines saying gold is dead? Who should I believe? Mm-hmm. I think I'll pick Mr. History over some guy on CNBC.
Mm-hmm. So, Jeff, going back to your article, what was the average price for silver if it had seen a gain like the other commodities did over that time period?
That's a great question. So what I did is I actually did get the average of the gain in all the other assets. Again, this is in metals, hard commodities, soft commodities, stock market, real estate, all of these things. And I just took the average gain of all those assets and applied it to silver. And the average silver price would be $250.28 if it averaged the gain of all the other assets from 1980. So, I mean, come on, everything should adjust upward over time just to account for even a little bit of inflation. It should be much higher. That's how much other assets have adjusted for inflation over 41 years. If silver does the same thing, the price would be over $250 an ounce.
Mm-hmm. You wrote another article analyzing time between past silver spikes. So what did that time end up at as well?
That's another good question, Tom. Basically, what the history shows is that silver is, stagnant for a long period of time. It's boring, boom is how I was characterizing it. That's its DNA. That's what it does. History shows this over and over and over again, right? We even saw it last year, right? It was boring for a while. It sold off a little bit in 2020, and then boom, it rose 140% from March to August just last year. So big spikes, right? Well, the time between, so I thought, well, what is the time between these spikes? And it did vary greatly. And of course, the time between spikes when it was a bear market was longer than when it was a bull market. If you take out the bear markets and you look at just the bull markets, the average time span was 2.5 years between these big spikes in the silver price. Well, it's been over a year now already since the last one. So could we have another year to go? Sure. But one interesting thing is that the average was actually never hit. It was always sooner than 2.5 years or longer than 2.5 years. So, we don't know. But what we do know is that another spike is, based on history, is inevitable. So another one is coming. I think it's our job as investors to prepare for that.
In your opinion, Jeff, what are the best forms of owning silver? Do you want physical? Do you hold ETFs or miners for exposure to silver?
I don't own any bullion ETFs. I don't want any paper gold, anything like that. And the main reason is because I don't want counterparty risk. I want to control, either in my possession or under my control in some way, the actual physical metal in my title and name. I don't want a paper product. And the reason is because we might actually need the physical in the upcoming environment. If things get really nasty, look at it. Everything's overvalued today, bubbly. What if this whole thing comes down at the same time? I'm not saying that's what's going to happen, but it's that reality, that possibility is definitely there. If this whole thing comes crashing down, there's going to be a lot of ugly counterparty risks that are going to show rear their ugly head, right? And that could apply to bullion ETFs. I don't want counterparty risk. Think about it. Why would I take a low risk asset like physical gold and silver and put it into an environment that makes it more risky, that exposes it to counterparty risk? I don't want to do that. Under normal circumstances, if it was a normal economy, normal markets, normal monetary system, hey, owning a paper gold product may be fine, but not in the kind of environment that is likely to transpire over the coming years. I want to minimize my risk, not add risk to my gold and silver holdings. And so for that reason, I own physical only. Mm-hmm. Now, as far as the mining stocks, that's more of a speculation. Obviously, I think everyone knows that. You're trying to gain leverage on the move up in gold and silver by owning mining equities. And I do spend a fair amount of time in that. I love it. It's fun, but I am aware of the fact that I'm taking more risk by doing that. But you can certainly add juice to your portfolio if we're right about the direction of gold and silver. And that's the key. Some people are asking, well, aren't gold and silver stocks going to crash if the stock market goes down? Well, the key there, the answer to that question is, what are gold and silver going to do? Mm-hmm. If you think gold and silver are likely to rise, over time, in response to some event, then the mining stocks are likely, historically, they will follow gold and silver. If you think gold and silver are headed down, then the mining stocks are going to follow them down. So in other words, they're more likely to follow gold and silver themselves as opposed to what the S&P or the Dow do.